Most Americans hear about a foreign crisis and assume it belongs to someone else. Another map, another distant threat, another headline that burns hot for a day and then disappears. But some crises do not stay overseas. They move quietly, through oil, through shipping, through financial fear. And then they reappear somewhere far more personal. In the renewal notice on your car, in the cost of protecting your home, in the premium you barely noticed last year until now. And that is what makes this story dangerous. Because it may sound like a foreign story, but the bill can land in the most American place possible. Your monthly insurance payment? Insurance does not exist to predict the future with perfect confidence. It exists to put a price on uncertainty. That is the first thing most people miss. An insurance company is not asking whether a war is happening far away because it cares about the headline alone. It is asking a colder question. Does this make the world more expensive, more unstable, and harder to model? Because the moment the answer starts leaning toward yes, pricing pressure begins. And this is where the story gets bigger than one company or one country. Insurers do not carry all of that risk by themselves. They spread it through reinsurance capital markets and larger financial networks built to absorb shock. But when global instability rises, those shock absorbers get more cautious too. The cost of protecting risk can rise at the top of the system long before ordinary families hear a word about it. By the time it filters down, it no longer sounds like geopolitics. It sounds like a higher premium, a tighter renewal, a smaller margin for error. Not ideology, math, not panic, pricing. And once that machine starts recalculating danger, the people furthest from the crisis are often the ones who end up paying for it. But that is only the framework. What turns it into a household problem is what happens when global risk collides with oil shipping and the daily cost of moving the world. The next link in the chain is energy, because when conflict spreads across a vital region, oil does not need to explode to do damage. Sometimes fear is enough. Traders start pricing in disruption. Shippers start calculating detours. Markets start asking what happens if a route becomes riskier, slower, or more expensive. And that question does not stay on a screen in New York or London. It moves outward, into fuel, into freight, into delivery schedules, into the hidden cost of keeping supply lines alive. That is how a distant crisis begins changing the cost environment without most people noticing it in real time. If fuel becomes more volatile, transportation becomes more expensive. If shipping lanes feel less secure, cargo moves under greater risk. If logistics tighten, goods arrive later, parts cost more, and businesses pay extra just to preserve normal operations. The world does not have to break completely for pressure to build. It only has to become more fragile. And once that fragility enters the system, insurers are no longer looking at a calm, predictable landscape. They are looking at a world where repair costs, replacement costs, transit costs, and financial exposure can all rise together. That is when a foreign headline starts turning into a domestic bill. But fuel and freight are only the first layer. The real hit comes when that pressure reaches the things Americans pay for every single month. This is where people often misunderstand how insurance really moves. Premiums do not usually jump because of one explosion, one speech, or one dramatic night on the news. They rise when the entire cost environment starts shifting underneath the system. And that shift can happen quietly across dozens of categories at once. Take a simple car accident. If replacement parts cost more, the claim costs more. If shipping delays keep a vehicle in the shop longer, rental coverage costs more. If electronic sensors and imported components are harder to source, repairs take longer and payouts climb. Now widen that same logic to homes. If roofing materials, lumber, wiring, glass, labor, and transport all become more expensive, then the cost of rebuilding after damage changes too. Not in theory, in dollars. And this is what insurers watch with ruthless attention. They are not reacting to headlines alone. They are studying what future claims may cost in a world where energy is unstable. Logistics are strained, capital is tighter, and uncertainty spreads across industries at the same time. The danger is not one event. The danger is accumulation, because the bill does not arrive all at once. It arrives quietly, through repair estimates, through contractor costs, through delayed parts, through a renewal notice that looks only slightly worse than last year. And that is what makes it hard to see until it is already inside the household budget. Start with the car, because that is where this becomes painfully real for millions of Americans. Auto insurance is not built around simple machines anymore. Modern vehicles are packed with sensors, cameras, computers, and specialized parts that cost far more to replace than most drivers realize. A minor crash is no longer just bent metal in a paint job. It can mean recalibrating safety systems, waiting on imported components, paying higher labor costs, and keeping a rental car longer while the shop chases parts through a stressed supply chain. That is where a distant crisis begins to feel intimate. If global instability pushes up shipping risk fuel costs and the price of moving goods, then the cost of repairing a vehicle does not stay still. It creeps. A bumper becomes more expensive. A headlight becomes harder to source. A repair that used to be manageable becomes a drawn-out claim with more delays and more money attached to it. The driver may never hear the phrase reinsurance market. They may never hear the phrase geopolitical risk premium. They do not have to. They see the result when the renewal arrives and the monthly number feels just a little more punishing. And that is the cruel part. The war does not appear on the invoice. The instability does not announce itself at the body shop. It hides inside the cost, inside the delay, inside the premium. And if even the car in your own driveway is not insulated from a crisis far away, then the story is about to move even closer to home. Now move from the driveway to the front door, because the same pressure does not stop at auto insurance. It reaches the home, and once it reaches the home, it reaches something even more emotionally loaded than transportation. It reaches security itself. A house is not just wood wiring, shingles, and drywall. It is the place families believe will still be there when everything else feels unstable. But insurance companies do not price a home based on sentiment. They price the cost of rebuilding it, and when materials, labor, transport, and financing all become more expensive in a more volatile world, that calculation changes fast. Then the circle widens again. Travel insurance begins to look different in an age of rerouted flights, regional instability, and sudden disruption. Business insurance starts absorbing pressure from higher operating risk, slower deliveries, and more expensive inventory. Commercial transport faces the cost of moving goods through a world that feels less predictable and less forgiving. Every layer adds friction. Every layer adds price. And those prices rarely stay where they start. Businesses pass them forward. Carriers pass them forward. Service providers pass them forward. By the time the effect reaches ordinary people, it no longer feels like an international crisis at all. It feels like a more expensive trip. A harder home renewal. A tougher month for a small business trying to stay open. And this is where the story becomes impossible to ignore. Because once the cost of instability enters the systems that protect movement, property, and livelihood, a foreign headline stops being something you watch. It becomes something you live with. What most people never see is the layer behind the price. They see the premium go up and assume someone got greedy or that a company simply decided to charge more because it could. But insurance usually does not harden for one reason. It hardens because an entire system starts preparing for a more expensive future. That future is built out of overlapping pressure. Repair costs, medical costs, material costs, supply delays, financial volatility, capital caution, claims assumptions, changing all at once. And when that machine looks ahead, it does not ask whether one foreign crisis alone will break the market. It asks whether the world as a whole is becoming harder to insure at yesterday's price. That is why the increase can feel so invisible and so infuriating at the same time. The family opening a renewal notice does not see the global web of risk being repriced behind it. They do not see the models adjusting for uncertainty. They do not see the institutions above the insurer demanding more protection for taking on more danger. They only see a monthly bill asking more from a budget that was already under pressure, and that is the trap. By the time ordinary people feel the cost, the logic behind it has already moved through layers of finance risk and corporate caution most never knew existed. So the question is no longer whether global instability can touch domestic insurance. It already has. The real question is where it shows up next. This is the moment the illusion breaks. Americans are taught to separate foreign policy from household economics as if one belongs to map summits and military briefings, while the other belongs to kitchen tables, grocery runs, and overdue bills. But in a connected economy, that wall's much thinner than it looks. Risk travels. It moves through fuel, through shipping, through credit, through the price of materials, repairs, labor, and protection. And by the time it reaches the average family, it no longer looks like geopolitics. It looks like another monthly charge that got harder to carry. That is why the phrase war far away can be dangerously misleading. Distance does not protect a household from cost. It only hides the route the cost took to get there. The public sees the explosion on television and thinks the damage is happening over there, but the deeper damage often arrives later. Without smoke, without sirens, without a breaking news banner. It arrives through recurring payments, shrinking margins, and a growing sense that normal life is becoming harder to afford. And that may be the most unsettling part of all. The crisis does not need to cross a border in the traditional sense. It only needs to alter the price of instability across the global system. Because when the bill finally shows up, it does not carry the name of the conflict. It does not come stamped with a battlefield map. But it is still part of the cost of that crisis. And this is where the story finally stops feeling abstract. Because most families do not track reinsurance markets. They do not spend their evenings studying shipping risk, oil volatility, or the cost of capital. They live by the numbers that arrive in the mail, on the screen, and in the account balance at the end of the month. And when insurance rises, it does not rise inside a vacuum. It competes with groceries, rent, repairs, medicine, gas, school costs, and the small plans families keep making just to feel like they are still moving forward. A higher premium can look modest on paper and still hit hard in real life. It can mean putting off a repair, delaying a trip, dropping coverage options that once felt responsible. It can mean one more decision made under pressure, one more trade-off inside a household already tired of making them. For small businesses, the squeeze can be even sharper. Higher coverage costs do not just sit on a spreadsheet. They shape hiring, pricing, delivery costs, and whether expansion feels possible at all. So what gets eroded is not only money, it is confidence. The sense that the future can be planned. The sense that normal life still has room to breathe. And that is the moment this story changes names completely. It is no longer about a crisis somewhere else. It is about this house, this car, this business, this month. So here is the truth hiding underneath the headline. A foreign crisis does not have to send troops, missiles, or shockwaves onto American streets to change American life. Sometimes it only has to make the world more expensive to insure. That is enough. Enough to raise the cost of moving goods, enough to push up repair prices, enough to tighten risk markets, enough to turn distant instability into a routine domestic payment. And that is why this story matters. Because the most dangerous effect of global disorder is not always the one that looks dramatic on television. Sometimes it is the one that enters quietly, normalizes itself, and stays. Not a single blow. A slow drain. Not one terrifying invoice. A series of monthly numbers that keep rising until families stop asking why and start accepting less. That is how a foreign story becomes an American one. Not when people see the battlefield, when they feel the bill, and once that happens, distance becomes an illusion. Because the crisis may begin far away, but the cost arrives at home. The real lesson here is that modern crises do not stay in the categories people give them. Foreign policy does not stay foreign. Markets do not stay on Wall Street. Insurance does not stay inside corporate math. In a connected world, instability moves until it finds ordinary life. It shows up in routines and budgets and in the quiet calculations families make every month just to stay steady. That is what makes this so unsettling. The biggest price of a global crisis is not always paid in one dramatic moment. Sometimes it is paid slowly, invisibly, through the things people thought were fixed and familiar. And once that starts, the damage is not just financial. It is psychological. It changes how secure people feel about tomorrow. If you're watching this, comment your location and local time, and subscribe if you want more coverage that shows how distant headlines become real-world costs at home.